Welcome to StockOdds Odds and End podcast. I'm here today with Rob Friesen. I'm Dave Singh. Good evening, Rob. How's everything?
Good evening. Great. Appreciate it. Hot summer. You guys pretty warm down there?
Yeah, it's swim weather down here every day. Close to
It's
100. Nice.
Yeah, it's nice, but interesting globally how some places getting floods in Iran and
Extreme heat. Yeah.
I mean, it's been really interesting. United Arab Emirates had flooding too, so quite something. Yeah, it's extreme weather globally, as are the politics, as are the drumbeats of war. You've got saber rattling now, China-Taiwan thing again. This is kind of comical in a sense that people are attributing China's provocation against Pelosi. I mean, they've always been rattling about Taiwan. This is nothing new. It's just, let's use this. This is a good vehicle to use to shake our fists some more and threaten. So, but it's an active, an ongoing situation, as is the Ukraine war, and I don't know if I lean into the media as much in terms of accomplishments by the Ukraine military there. I think the battle is, it just, how many days are we in this thing now? It's been how many days since Russia invaded?
Seems like almost half a year now, right?
Yeah, it's like, so it keeps on going, and there's no slowing down in sight here. So, I fear at the end of the day, it's unfortunately going to be, well, how do you put it? I don't know if the Ukraine can hold them off, and win ultimately. So it's a tough one. So with that, we can expect that some of those issues that are centered around war and conflicts and stuff are going to continue. We have an interesting marketplace with the recession debate continuing, and it's amazing to hear people think it's going to be not at all and very shallow, and others very deep and prolonged, and so you get a wide variety of opinions on that subject. But I am noticing a couple, things occurring in the commodity area, as we talked about last week as well, but also the U.S. dollar. If you take a look at that, you'll notice that it kind of peaked on July 14th, and it's been sliding down since. It is sitting on a trend line that goes now back to the beginning of the year, so it's sitting there. But why the dollar is important to watch is because there's carry trades that go on. The bigger one now that's producing better than the dollar is using the euro to fund the carry trades. But the commodities are priced in dollars, right?
And they bottomed about the same time. If you look at copper, it bottomed about the same time, mid-July as well. It's been coming up since.
Yeah, so the case for metals was not there while the dollar was making new highs. So the price was really being paid in the metals area especially, and other commodities as well. But now with the dollar starting to slide, coming off its highs, and why would that be? Well, the dollar rally was fueled by interest rate hikes. Now other countries are starting to also raise their interest rates to be competitive and to deal with inflation as well. So on a relative basis, the dollar is weakening a little bit to them. But we're also looking at what was kind of communicated is, that the rate hikes they would be data driven, of course, but they would be less aggressive than what we've just seen. is the information that I take away from all that. And so the dollar is like, okay, well, we'll take our profits if you've been long the dollar, or we'll, short it and buy other things that are, more important, right? At this point, or more opportunity at this point. So the commodities are definitely something to watch, and they're starting to turn up. Let's look at the futures here for tonight. Since they opened, we've had some movement already. We're in a very interesting spot on the Dow Jones futures because we're still below the 33,000 level. We're at 32,759, but that 33,000 level is right smack dab in the May 27th to June 8th consolidation phase, and that was before we broke down with the real concerns of massive recession and all that. So that's what really tanked us on June 9th and after that. But we're right back up, just sitting below that consolidation zone. So that, just keep a note on that, the 33,000 on the Dow Jones futures. And we had a big rally last week. And one of the things that we look at is where we closed Friday on the weekly and looking for a potential reversal of that week to week. So every week is kind of a reset. It's always fresh when we look for potential reversals. So whether we can build on this in the next day or two, the rally that we just had, we've still got to get through this consolidation zone at that 33,000 level, right? And the same would be true with I should say that the Dow Jones futures are off 143 right now, 0.44%. The S&P is off 0.43%, or 17.75 points. So about the same as the performance on the Dow Jones futures. And it's also got the same consolidation zone, although it kind of tapped right into the middle of it, corresponding to the lows set March 15th and March 8th, and just a little bit above the February 24th low. So the S&P did punch into it, so it was performing just slightly better than the Dow. Again, because of some of the tech stocks and being a market cap weighted index, it did outperform the Dow Jones or the diamonds, which are a price weighted index. So there's a difference in their construction, and one's more defensive, one's a little bit more aggressive. So the S&P 500 would be more aggressive over the Dow 30, right? And so moving on to the NASDAQ 100, that actually, because we've had an appetite for the tech comeback tour here, the tech stocks did outperform the general pack of the S&P 500, including the tech stocks there, which some of them overlap, of course, and the Dow 30 for sure. And we made it above that consolidation zone that we had March 27th to June the 8th. And so the key now is the NASDAQ has plunged right into the February 24th low, and also the almost matching low of March 14th and March 15th. So it's punched into that, and it's sitting here with the question mark of, well, we made it all the way back to that point. Do we continue up? And if we do, there's a lot of numbers to go through. There's a lot of what was former support that could become new resistance. So there's a lot of numbers, but there is also this blue sky air pocket above us. But right now we're sitting at a critical junction on the NASDAQ 100, but it did clear the May 27th to June 8th consolidation. So it's above that. Russell, and I should say that the NASDAQ 100 is off 0.37% right now, or 48.5 points. The Russell is off the most of the four horsemen there. It's off 0.65% or 12.2 points. And it did not make it to the top of the consolidation. It had a kind of a different consolidation pattern anyway, not as symmetrical as the other indexes. But it's sitting right now at its February 24th low. So it's like the NASDAQ 100 as well. So it had a pretty good run off the bottom too. It's been performing really well, especially on the risk on days. You know, it can give you some monster rallies, the small caps, and you know there will be a hunt for small cap value by investors that are willing to tread into these waters. So keep that in mind. The NASDAQ 100 is still, you know, an area that people love too. Some of the stocks in there. So we had for the first 6 months of this year pretty good performance by the value stocks over the growth stocks. And so in light of that, if they rotated into some of those to stay defensive, some of those stocks actually did pretty well so far this year. So you might see that if the rally was to continue, they kind of shun some of the more value ones and tread back into the riskier assets. Just looking at the VIX, it's at 2360. It's up right now 0.79%. So again, corresponding to the markets pulling back a little bit. But you know, it came way off the high from the 34. Well, that wasn't quite the total high, but the most recent oscillation was up to 34, and it's pulled back pretty good. So anyway, let's go over to Dave here. You got all kinds of stuff to rattle off here. So let's get started there.
Yeah, it's the first day of the month. So in August, it's expected to do something like 0.7% for the entire month, but it's really weighted towards the end of the month. The first day is pretty muted. The first week, first Friday, mid-month seasonality is expected to be down. Same with options expiration. But the last 5 trading days of the month, the last 3, that's where all the gain seems to be happening. And it ties in with what you said before, right? August has low volume. People take their vacations during that month.
Low institutional activity until sort of the last 5 days when they get back to work, right?
Yeah, just before Labor Day. So that's what the almanac says in terms of when we might expect some of the performance for the month. But as for the first day of the month, there are some sectors which look to be stronger than others, and they're in healthcare. The XLB, even biotech, XBI, IBB, and technology, QQQ, XLK, the SMH chips, and utilities. So those would be some of the ones that show up to be stronger according to the almanac for the first day, and shorter things like energy, XOP, XLE, basic materials, XLB, industrials, and some financials. So it's a little mixed there, but that's what the numbers say for the first day.
Yeah, hold on. Let me pause for 1 sec there. So you notice the theme here. We've got on that first day some of those like XOP, XLE on the underperformance side. And if you want to kind of play in that, I mean, there's 2 choices. You can just use the ETF, right? You could also go into the web screener and look for symbols within those groups, either the drillers or just the basic energy stocks, and look for the ones that have the best odds of underperformance, so that you're kind of aligning the symbols with the backdrop of the ETF. So that means you're kind of being thematic. If you want exposure directionally. If you don't want exposure directionally, then go in that group and pick up some longs and short ideas that you can be hedged, and then you can use the market gap. So for example, if we gap down, you might say, I'm going to be very conservative on my shorts. I might pick up some longs, but if I need to hedge, I can hedge immediately. If we gap up in that sector, if you see oil for some reason strong tomorrow morning, you can sell first, do some shorts, and if you need to hedge, then hedge. So there, you can be very strategic about, going in and mining for the best stocks within a group. Okay.
Good. And in terms of energy, we just talked about that. There's an OPEC meeting this week as well. So oil prices are a little week ahead of that. So that ties in, kind of in lines with what we're seeing in the almanac. So a little bit weakness in energy. There are some economic calendar things this week. There's centered around things like manufacturing on Monday, the manufacturing PMI, and then ISM services on Wednesday, and jobless claims on Thursday, and unemployment rate and payrolls on Friday. So the themes are manufacturing, services, and unemployment in terms of the strength of the economy. And that can give some data as to whether we are headed more towards a recession or things are really not that bad. So we're going to have that backdrop in terms of economic reports. And yeah, I mean, Bitcoin's firming up as well, right? So it's that risk on undertone that aligns with
there certainly has been, last couple weeks, the risk on undertone, that's for sure, right? But that brings us, and that is produced, and it brings us up to a critical inflection point. Whether we can build on this or whether we're going to revert back. That's how important, where we've arrived here. It's strangely enough at the end of the month and the start of a new month, which is kind of a quiet month anyway. In the past, most of the volume within August was, programmatic, like program trading and algorithmic, right? Mm-hmm. Imagine you're going to continue to see that, which means it trades a lot around VWAP. It trades a lot technically, and just a lot less, human participation from people really wanting to load up. So I think they wanted to catch some of the rally and not miss out, and we saw that happen. But going forward right here, if we don't build on this, they're going to probably hold back on the spending, right? If we start to slip back, they're not going to want to rush in right away because we want to see if we can retest the lows or, I don't know. It's just one of those things that we're at a critical point to either build on or slide back. That's the point I want to make. So,
and the last noteworthy thing here is the U.S. 10-year Treasury. We're at 2.67 on that. That's down sharply from a month and a half ago. So mid-June we peaked at almost 3.5. So we're almost a 1 percentage point lower within the last 6 weeks or so. So
what the market's signaling from that is because of the economic woes. So there's the theme that the economy is strong, and then there's the question whether it's really that strong because, for example, Walmart came out and said, hey, we're having to cut prices because we've got inventory surplus. And so if these companies have gone from, first of all, supply line problems and not enough goods, and all of a sudden everything got ramped up and things started to open up, and now they've got too much goods, but the consumer has cut their spending tremendously, then we start to have a little bit of a deflationary problem, or like, how are you gonna stimulate things again? Well, you got to cut interest rates again, right? So this is what the market's kind of signaling is like, well, we're not too optimistic on the Fed being able to keep that pace, that aggressive pace going. We're going to bet that it's going to be shorter lived than what has been, kind of communicated. I think that's what the market's signaling through that pullback on the treasuries.
And the other thing I've heard about lately is the debt service the U.S. government has gone way up, right? Because as interest rates go up, it's a lot more expensive for them to service their debt. So at some point, it's not in the interest of the government to have really high interest rates, right? So there's going to be pressure to push rates lower.
Definitely. But yeah, it's really interesting to go through and really orientate yourself with all of the commodities and futures and currencies. And, like, for example, look at the Japanese yen rally off the bottom there. It's been in just a massive downslide since March, and all of a sudden it's just shot up off the bottom. So these are major changes that are happening. And when the regimes change, then different sectors respond, different industries within the sector, and of course stocks. So right now we've had a bit more risk on appetite, and we wonder if that will continue. And if it does, we're fine with that, because at the end of the day, we really are not directional traders. There are opportunities to take some direction if you can get a good macro read, and especially if you have seasonality data and individual odds data. But there's more chance to be, wrong when you choose a direction in a group. If you choose symbols across the board that are very diversified, representing a good diversified long basket against a good diversified short basket, you run less risk of that directional exposure. And then you're making money. I have to keep reinforcing this all the time with, communicating to retail traders and so on, is it's about the relative performance between your long dollars and your short dollars. However you choose to hedge, however you choose to get those short dollars, whatever vehicles you use, but it's about that relative performance. So generally speaking, just a note here is on big, strong up days, most of the time your stocks, if you chose stocks that were more discretionary, risk on type technology stocks, things like that, they would outperform the ETFs. On down days, they would underperform, meaning that you would lose money. So you'd have exposure to the risk side, right? So if it's a risk on day, you would probably make more money than the ETFs. If it's a risk off day, you'd probably lose more money than your hedge of the ETFs. So that's where the balancing act comes in, by knowing kind of what to expect in what types of markets. And so if we roll back down and we're moving towards really oversold or just weak sentiment, and the selling is there, then having beta hedges in place, increasing your weight, being more defensive on your stock selections. These are the kind of things that make a difference. When it's a risk on appetite, then you want to press the discretionary, you want to press the tech, you press the risk on areas, and move to more long dollar capital, short dollar balance. You don't necessarily need the beta adjustment. Beta adjustment works well on the down markets, right? Doesn't work as well on the up markets. So I hope that helps. It was interesting when I was running some screens for this week at what kind of symbols, it's a lot of times when you see your odds and your average performance come up, it's kind of like a mixed bag of sectors in your top 20 selections. But I was surprised at how concentrated it was into, like, for example, XLB. Like, the top 6 stocks in one of my screens were all chemical stocks, which are part of the XLB. Mm-hmm. So you might find some interesting reinforcement when you look at the seasonality calendar and see what's expected to occur on the first trading day of the month, and maybe, this first week of the month. We also have the first Friday will be coming up at the end of the week, right? So when you take a look at those themes, and then you go and run your other screens like RSI and %B and, CCI and move open to close, and then you start to see a clumping of sectors that match your seasonality. That's a nice lining up the ducks, right? So use it. It's there for you. Anything else, Dave?
That's it for me.
Okay. We're, getting past the bulk of most of the S&P companies reporting. There's still some earnings to come. Obviously, keep your eye on the calendar. But, we went through some of the bigger names here in the last 2 weeks. So anyway, good trading this week. And just watch for light volume tomorrow. Some of the Canadian institutions are offline because of holiday, and so volume should be fairly light tomorrow on the exchanges in general. And this month is just a lighter volume month overall. So be careful. Watch your liquidity. Watch the way you trade, especially if you're doing market orders at the open. You don't want to be paying up 10% on a gap up on a thinly traded stock, because there might be nobody to sell it to if you need to get out of it, right? So watch your liquidity. Okay.
All right. Good luck.
Have yourself a good one. Good trading this week, Dave.
Goodbye.